Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Chicago and talk with Mish Shedlock of MishTalk.com. Mish, welcome back.
Hey, a pleasure to be back on, Max. We're seeing some fireworks here, a little volatility. What do you think that's going to do to all the European funds short selling volatility? I think they're going to get smashed on this trade, Max.
Yeah, that's an interesting idea. There's been a trade on for a few years now in the hedge fund community in particular where they are short volatility, they're short the VIX, and this has been highly profitable for a few years. And the VIX made a huge leap on the upside. And I guess what you're suggesting there is you got some blood in the street now with that particular trade. So where do you see this market going, Mish?
It depends here. Typically what we've seen is just a one-day pullback and then renewed highs. But we're seeing what, down a few days in a row. The Dow, as we're talking here, is down 500 points. I'm not sure where it's going to close. That's a pretty significant move. It was down over 300 points a couple of days ago. So we're seeing the start of something here. What these hedge funds are doing, Max, is their attitude is whenever volatility spikes, they just short more of it and more of it. Well, Max, if you keep doing enough of that, you're eventually going to get blown out of the water. And I actually think that's going to happen.
Right. That's the martingale system of betting.
Yes, that's exactly what it is.
Yeah.
Good analogy, Max.
Yeah.
Great analogy.
Yeah, you're constantly doubling down on a betting on red at the roulette wheel with the idea that eventually you will win before you run out of money. But this is what you have in an environment where you can borrow money from the Fed at 0% interest rates, and you can borrow virtually unlimited amount of money from the Fed at 0% interest rates. The martingale strategy of betting is a winner because you never run out of money. And that's why we've seen these incredible dislocations in these markets and a collapse of capitalism as we know it. But let's talk about GDP. The Atlanta Fed says that Q1 2018 will show a pretty remarkable 5.4% growth. Your thoughts?
Pretty remarkable? How about impossibly remarkable? I don't know. I suppose by some perversion it can happen. I mean, you and I are not responsible for being able to measure this thing. They are. But what we've typically seen, 3 in a row or maybe even 4 out of 5, the Atlanta Fed comes out early at the start of the quarter with these remarkable forecasts. You know, they were 4% at the start of the last one. What, it came in at 2.6. Now they're 5.4%. Every time these reports come out, Max, I feel it as like I'm betting on a spread, the over-under line at a football game in the NFL. And I made my typical comment here about the Atlanta Fed model. It was, I'll take the under, way under. You know, if this is an over-under betting line and the line is 5.4%, Max, I don't think so.
It does portend some inflation, and we've had a 38-year bull market in bonds going all the way back to 1980 with Volcker was the Federal Reserve chairman. Reagan was in office. And we've had a bull market in bonds ever since then. And we have 0 interest rates we talked about. In some countries now, interest rates are negative. But so the question is, with rates now climbing higher, is this finally the end of that bull market? What do you see there, Mish?
I don't know, but I don't think so. People are claiming, Bill Gross has claimed, I believe this is the 3rd time now, Max, the end of the bond bull market. Well, maybe he's right this time, but maybe he's not. Certainly, we are seeing an inflation scare, if nothing else here, maybe the real deal, and maybe the real deal for a while, maybe the real deal for a quarter. But what happens if the Fed hikes once too much, starts a recession? Actually, the next recession is baked into the cake. They're going to blame it on the Fed for hiking one time too much, but that's not what's going to have done it. It's going to be all the excesses the Fed has created in this bubble, just like they created the dot-com bubble and the housing bubble. We now have the everything bubble, Max. So, and people are going to say, we raised rates one time too many. They'll probably blame it on the new incoming Fed chair, Powell. But this was baked in the cake under Janet Yellen. with these baby steps, just as Greenspan did until the housing bubble finally blew up. Did the same thing under Yellen. So what's going to happen, though, here? This is the question, Max. If we get an asset bubble, if stocks start falling, and more importantly, if commercial real estate and home prices start falling again, what's that going to do to bank profits? What's that going to do to their ability to end? Banks are going to become capital impaired. We're going to be in the same situation or similar situation we were in 2007. Asset prices falling. No one wants to borrow money. So what's the Fed going to do? But they're going to cut rates. That's how I see it. And actually, if the asset bubble gets big enough, I actually think we're going to see outright deflation. So the Fed's maneuvers to prevent deflation are what's going to cause it, in my opinion.
Right. I've said that many times. The Fed's attempt to fight deflation actually causes deflation. And Danny Branchflower always jumps in on Twitter and says that's crazy talk. But, that's exactly what's going on. But let's return to this martingale betting theme, which is that you can keep doubling down on a bad bet until it becomes a winning bet. You mentioned that stocks pull back on a one-day situation, then hit new highs. You talked about the housing bubble in 2006, 2007. It looks like we're returning to that kind of era. And in all of this, if you were to point to one common theme or this source for all of this global asset inflation, and you'd have to come back to the Bank of Japan. Bank of Japan has been the go-to currency. They're driving this entire bubbleonomics and the top of everything. And now they've recently said, Mish, they're proposing to spend, quote, unlimited amounts buying their 10-year bonds at 0.11%. So if they're going to still doing that, Mish, then yeah, this is just going to continue on for a while, right?
That wasn't even a new announcement, Max. That's the funny thing. They came out and said that 3 days ago. But I said, haven't we heard this message here before? And indeed we did. I went back and I looked and I found they said the same thing in Financial Times report. I think it was August, of last year when they said it. And they probably said it before that. Somehow they've drawn this line in the sand, Max. It's at 0.11%. So I said on my blog yesterday, and I said, what's the message here? That Japan can't stand a 1 basis point rise in bond yields on 10 years? I said, gee, the 10-year note in Japan must be really attractive at 0.11%. All of these fund managers, in Japan want to hold on to these things. No one else in their right mind has them anywhere else in the world. So, so I did this sarcastic post, Max, on my blog, and I said, why does Japan, threaten to, just buy all of these at this floor? Why doesn't it just do it, Max? Go out there and just buy every bond. Why not? Of course, some fund managers might not want to give up those attractive yield 1.1 or 0.11% yielding bonds on 10 years. So I said the way they can get them to release them, Max, is if they tax anyone who holds bonds at 1%. Now, these guys are losing 1% a year on these things. We're going to unload the things in mass. Bank of Japan can buy them all up, every one of them. Now, look at the beauty of this, Max. We can finally test MMT, the monetary theory that government spending doesn't matter, and we owe it to ourselves. Because after they buy them all up, they can cancel all of the debt, null and void. Let's do it, Max. What do you say? Let's test MMT now. What do you say? Well,
Japan's got the highest debt to GDP. They've got the highest debt to versus their central bank.
Oh, they'll be canceling it, Max.
Yeah.
Boom.
Yeah.
Cancel.
Yeah.
They're going to buy up all these bonds, cancel the debt, period. Start with a clean slate. Let's do it. Let's go for it. And I propose one more step. While they're at it, why don't they just buy up all the debt of corporations too, given that they're buying all these stocks willy-nilly, as is the Swiss National Bank? Just buy it all, Max. This is what MMT says we can do. I'm ready for a test.
Well, I mean, okay, so just to follow up on that, the reason why the problem there is that these debts have been rehypothecated and pledged against other assets and banks all over the world. So canceling Japan's debt would, in effect, put the global economy into a free fall, and it would immediately come to a grinding halt because of the fraud that happens on the central.
Now, you know that, Max, and I know that, or we might think that, but this isn't what the MMTs there say.
Oh, yeah.
This isn't what the
All
Keynesians
right. Mish.
So let's give them their test.
Yeah. I want to before we have to leave. Now, let's talk about something that's, I think, the most ridiculously off the charts nonsense I've seen in quite some time. And, you know, I know you tweet a lot about Bitcoin. I talk a lot about Bitcoin. You see Bitcoin as being fantastical and not worthy of comment. But compared to this story, Mish, it makes Bitcoin look like a AAA gilded bond. Okay, your own state of Illinois, they have a plan to fill the pension black hole by selling $107 billion in bonds and then using the proceeds to buy stocks that are now at all-time highs. I mean, Mish, what are you smoking over there in Illinois?
I don't know, Max. We talked about this a little bit a few days ago off the air. It is kind of amusing. What I proposed, their idea here, they was going to float $107 billion in bonds, and they were going to use it to buy stocks. Now, my guess is the interest rate would be 7%, probably greater. I think it would spook the bond market, especially right now. But let's assume they could borrow these things at 6%. They would need to have 6% returns just to break even. My proposal was similar to the Bank of Japan's proposal, was to buy those bonds and do something different. You know, throw $1 billion in the month on VIX bets that it's not going to sink but going to rise. My God, they would have made a fortune this month here already if they could have done it. But no, that's not what they want to do. They want to buy this money and do the same old thing. Meanwhile, Illinois is pensions are what, 40% funded or so. Actually, it's worse than that. I believe that's what they claim. But the next downturn is going to kill all.
Yeah, we got to go, Mish. Mish, we got to say goodbye.
Kentucky.
Mish, we got to say goodbye. We're going to pick this up again.
All right, Max. We always run out of time.
I know, because you've got a wealth of information, but we just are out of time. Thanks for being on.
My pleasure, Max.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Mish Shedlock. If you want to find us on Twitter, go to Keiser Report on Twitter. Yeah. Until next time, bye, y'all.